we're celebrating more than 2 million Canadians choosing Fidelity. And to say thank you, we're giving you a chance to win a branded Fidelity hoodie. Enter by visiting fidelity.ca/hoodie-contest. At Fidelity, performance is more than a number. It's progress, confidence, and momentum. So choose performance, choose advice, choose Fidelity. Now, here's today's show.
Hello and welcome to FidelityConnects. I'm Pamela Ritchie. Markets are whipsawing almost daily these days between risk on and risk off. In an environment like this, a balanced income-generating portfolio can help keep the ship steady, providing flexibility, resilience, and cash flow while markets swing. Our guest today says dividend investing hasn't been caught up in the AI hype as much, and he's focusing instead on physical assets, infrastructure, and businesses that simply can't be disintermediated. So how do you position for uncertainty, stay invested without chasing risk, and still get paid along the way? Where are the most durable opportunities at this point? Happy to say that joining us here today for a look at where he is finding durable opportunities is portfolio manager Don Newman. Don manages several Fidelity funds, including the Dividend Fund and Dividend Plus Fund. Warm welcome to you, Don. Nice to see you again.
Well, nice
How
to
you
see
doing?
you. I'm doing great.
Just to let you know, this conversation with you and between the us will feature live French, Mandarin, and also Cantonese audio interpretation. So join us in any language you choose there. Let's begin, if you don't mind, with, is it as easy as saying that so-called old economy companies, in fact, are kind of the winners at this point, and the newer economy companies are really at a disrupted risk that's high at this point?
Not necessarily a blanket statement, but
Okay.
certainly there are some. The dividend space has been a good space this year. The idea is that what I try to do is, good companies at reasonable prices that maintain and grow their dividends over time, and do it with a little bit less volatility. Has been sort of a good strategy, at least this year. And the idea of is the space I operate in has a lot of companies that have been around a long time, physical assets. Very hard for AI to come in and sort of disintermediate it. So you've seen it this year, like technology, software has been like a really difficult place to be. Like good business, repeatable structure. The problem is, can AI come and write all your code and someone can do it themselves? And that's a big question that's going on. There hasn't been too much of that sort of impacted the dividend space. So we've going from like decent earnings growth, good growth in cash flows, good growth in income, and we haven't had the volatility that maybe some of the rest of the market has been. So it's been a nice place to focus on this year.
Because we've been talking a lot about moments like this, remind everyone that diversification is really important. And if they had forgotten, this is a reminder, these types of moments. Just speak to that a little bit, because it's not like this is suddenly a balanced fund where you get everything. However, the diversification out of perhaps more risky growth is right here.
Yeah, I think the idea of just focusing on businesses that have been around for a really long time, that generate really good cash flow, where AI can't come in. There's like physical assets that the fact that you can write code or target people on marketing or do things faster than a human doesn't really matter when you're dealing with giant physical assets that take a decade to build and can never be replaced.
So apart from that piece of it, the AI piece of it, we're also watching some shifts within the world, the geopolitical stage. We don't need to go into all of them, but it seems that there is a really interesting premium on hard asset companies. The world needs to have some version of energy security, it appears, is front burner stuff right now. We're seeing consolidation in the energy sector in Canada. Just speak to that, because that's coming, and those are typically dividend producers.
Yeah, I mean, we look at sort of the Canadian energy patch here, and sort of if there was ever a really good example of sort of the value of secure assets in the ground that are actually accessible in geopolitically safe areas, we're seeing it right now. And you and I were talking about the show. We saw an example yesterday where Shell came back into Canada. They had sort of been leaving, and I think this is a pretty big statement. It's like, wow, the rest of the world is a little bit maybe shakier, more unpredictable than we used to have thought. We've got 20% of the world's oil right now. There's plenty of oil in the world, we just can't get it out. And 20% of the world's oil is not shipping through the Strait of Hormuz right now. So oil sitting in Canada, or natural gas sitting in Canada, in a geopolitically safe place where you know what you've got security of what you're buying, and you can actually get it out of the country, and you're sure about what you own, and then 10 years from now you probably still own that asset,
right.
And frankly, if there's not a bomb being dropped on it, is a pretty good place, or pretty interesting place. So there's probably a premium that starts to get put into the market for those type of assets. And you're seeing that for a lot of different commodities in the world, whether it be copper, oil, just any kind of secure material that the world is actually going to need for the longer term. It's not as acceptable now to be sourcing that from parts of the world that may not be as stable as what we have here in Canada.
So as an example, take this to the style of companies that are steady, that are dividend producers, that have generally a steady outlook. Because I'll ask you this question. Are some of the companies that you've mentioned, that type of what involved with materials, energy, and so on, do you kind of have to buckle up because they're going to reprice? They're going to be worth more.
Yeah, no, I think there is years ago, no one would touch a pipeline company because everything's going sort of ESG. We're not going to need the oil. Everyone's going to be driving an EV. And, administration changes, sort of the views in the world changes, adoption may not be as fast, and geez, we need it for transportation. We do need it. People are still driving gas-fired cars, and then along behold, it comes the sort of AI phenomenon where just power is paramount. And you can't do anything with the amount of power that these companies are requiring is something that no one would have seen 5-10 years ago. So suddenly someone that has a natural gas pipeline, this is really, really valuable stuff. And there is massive demand for that. And frankly, you can't build any of this stuff. And we were talking a little bit about it. It's all, how much do you got, and then where can we build? And the economics of building some of this new stuff, people are willing to pay a lot, and the returns are really good. Suddenly, these went from what people viewed as no-growth businesses to really, really critical infrastructure businesses that, by the way, generate really good cash flow and really good dividends. So good places to be in the world that we operate now, and they're also in geographically safe places.
When you watch this unfolding, will your companies, do you expect them to all grow their dividends, for instance? I know there's a lot of calculations within that, but is that
what I always have sort of said for years, and when I talk to companies is, listen, when we're talking about the way you're growing cash flow, and dividends are wonderful because it's not like a bond. Every year, if a company grows its earnings 8 to 10% or something like that, what I like to see is you tell me you got your payout ratio in which the amount of your earnings you're paying out as dividends in a really good spot that's sustainable. And if you're growing your earnings 10%, let's see a 10% growth in your dividend. So the percentage of what you're paying out stays the same, but you're doing this wonderful thing. The value of your stock should go up because your earnings are going up. And if we capitalize it at a reasonable sort of multiple that stays the same, we're growing earnings 10%. Hopefully the value of your stock goes up 10%, but we're also paying out a nice dividend, and that earning stream is actually growing at 10% as well. And it's wonderful for someone who's trying to fight inflation, which we may have
a
little sort of perk up in. And it getting more cash flow every year as opposed to a bond from good dividend paying stocks does wonders for the income coming into you and your ability to go and fill up that gas tank, which was more expensive, go to the grocery store, which was more expensive, pay your rent. And it's this nice sort of hedge against inflation that sort of helps you maintain your purchasing power over a long period of time.
And potentially these companies have a lot of growth yet to come because they are going to expand on some level.
Yeah, and it's a lot of sort of old economy companies that, as I said, people thought maybe it didn't grow as much. Suddenly, the demand for a lot of their service is going up, and the growth outlook looks a lot better than it perhaps has in decades.
What about the risk outlook? What are the risks? It's lower risk. These are traditionally lower risk companies. There does seem to be, maybe an argument to be made that AI has a lot of demands, it appears, on energy, on data, on things that need to be built by some of these companies, or at least have supply chains feed into them. What if that collapses a little bit? I mean, do you look at that risk? Or?
Yeah, sure. So what you've got to be careful of, and this is what we certainly have our analysts doing, is, okay, you give an example. You're looking at, everyone wants to build a data center.
Yeah.
So where is the data center located? If you're in some incredible hub next to critical infrastructure and that is going to be needed forever, that's great. That's probably worth a lot. If you're in the middle of absolutely nowhere and someone's trying to build something, and if the demand falls off, this is the first thing that gets cut, and there's no actual need for it other than some hyperscaler or some company decided, oh, I need the power, and let's put it out in the middle of nowhere. That's going to be a stranded asset that no one needs. And we want to make sure that the quality of the contracts that people are signing, the counterparties they're signing it with, are these businesses going to be around in 30 years, or is this something that's sort of a flash in the pan? And it's like, oh, we're going to build a multi-billion-dollar facility, and the company we're doing it with, by the way, generates no cash flow, and this doesn't really make a lot of sense. This is where the analysis comes in.
Those are the risks. Yeah, and that's where you analyze.
But something like, we use an example like a utility, what I say is, like, I'm not really sure, and this is the nice thing about sort of the way I think about dividend investing right now, I'm not really sure who's going to win, the whole AI trade. Who's fast? Who's going to have the best model? That seems to switch from sort of week to week or month to month.
You don't need to know.
But I'm not really concerned. Yeah. Someone will win, the demand is going to improve. And I think we've talked about, like, utilities in the United States will say. It's a factor of using, like, this is the best demand they've seen since the advent of the personal air conditioner. Okay. But it's not all AI. It's also companies resourcing from the world has gone from, our PMs used to use the term like collaborative to a little more insular. Like, things are being reshored back into the U.S., maybe into Canada as well. You can rely less on your global supply chains, so more stuff comes back into sort of where it's being sold. That's good for demand. That's good for industrial demand. That's good for infrastructure. It's good for sort of warehousing. A lot of different things where kind of I play in is the dividend space.
And everyone gets paid to wait and grow ultimately their investments, generally speaking, as other things get sorted out, like who AI winners and losers might be on that side of things. This is sort of a really interesting place and arguably safer.
Yeah, and it's nice when we've got, as you mentioned, like risk on, risk off, toggling. Dividends, provide this nice baseline of income that, stocks go up, stocks go down on a different basis, but you're being paid that income, and as long as we're doing our analysis right, that income is coming into you quarterly. There's some companies that pay monthly, but mostly sort of on a quarterly basis. You've got that baseline of income, that stability that is there sort of no matter what the market's doing, and you have the ability to kind of wait things out. Things get a little bit choppier, fine. I've got a baseline of income that's coming in, and over time, as long as the companies are doing well, that income will grow, and you should get good capital appreciation as well.
When you look at various inflationary moments, and this might be a transitory one with the oil price, but it certainly affects everyone, and everyone is feeling it. It doesn't mean it's collapsing everyone, but it's felt.
Yep.
How do you sort of take this into your stride at this point?
Yeah, I'm sort of looking a little bit longer term. Certainly, anyone, you and I both, you go and if you fill up your car with gas, like it doesn't feel good right now. Like it's expensive. Certainly, groceries have gone up a lot. My sort of feel is. Let's see, the oil price will have a temporary effect on things, and it will have an effect on supply chains. And companies are now coming out and saying, okay, the extra oil price is going to cost us so much more in sort of packaging or whatever the case may be. it should be transitory. The oil prices should
That's
not,
good to hear from you.
over a long period of time. Hopefully, cooler heads prevail, but you're not sure. And we get the Strait of Hormuz open, the oil price will come down a little bit. That should be transitory. On the flip side of that, sort of looking longer term, we mentioned sort of AI. AI is going to be disinflationary. Productivity is going to go up. That means people can do more with less, and that's generally sort of disinflationary. So my view is, you probably have inflation temporary picks up a little bit, but over the long term, there's sort of a balancing of sort of forces that probably keep inflation at more reasonable levels.
You have access via the amazing connections that Fidelity provides to sit with management, obviously, and to make decisions along with knowing what their teams are up to. Just curious how we talk a lot about innovators and hyperscalers and some household names in terms of the CEOs and that kind of thing. How is management, generally speaking, at the companies that you invest in, just different? They have a different mindset because they have to. Yeah, so
it is a little bit of a different meeting when we have hundreds of companies, if not sort of thousands of meetings a year we do with our management teams across the world. What you'd see probably in like a meeting for like a NASDAQ company or someone that's just really focused they'd be focused more on just growing the business. And the meetings would all be around like, say, what's your market? What's the addressable market? How fast can you grow? How fast can we grow earnings? But there is no dividend kind of thing, because you're using all of your capital to reinvest in a fast growing company. For meetings that I would generally sit in, there's a little more of a talk about sort of capital allocation. So the company's already been around for a long time. They generate a lot of cash flow. And we want to know, how are you using the cash flow? So how much do you need for operations? How much do you need for capital improvements, CapEx, to grow the business? What you need, but it's not going to be as fast as someone that's a business that started 2 years ago. And then what are you doing how are you going to use the excess cash flow that you generate? Because you generate a lot of excess cash flow. Is it on acquisitions? What companies are available? How do you fill in the holes that you may have in your business? Is it on share buybacks? And then let's talk about the dividend policy. How do we get more while growing your business? I don't want all the money back if you can't grow. I want a growing business that can also grow its dividends. So let's talk about your dividend policy, your payout ratio. Let's talk about how your debt structure, whether that's appropriate or not. Do you need to use some of the money to reduce debt, or are you in great shape and you can lever up a little bit? And how much money you can, and how you grow that dividend coming back to the shareholders.
So on that, how do you view a moment? And I'll ask you one question on interest rates.
Sure.
But it is kind of an interest rate week,
Yep.
so we have to. The idea that they're low in Canada now, they've come down, the cutting has happened. We think maybe the cycle is finished. They'll probably sit at neutral, we don't know. But what does that release for company management to do or not to do? What is this moment? There does seem to be inflation kind of flying around to the wind. Some people think it's back. Who knows?
My personal guess is, that probably the central banks are on hold for the foreseeable future. There's enough uncertainty right now where I don't think they want to be taking, a shot one way or another that may come back to haunt them. So I think that the safest thing for them and the smartest thing for both the Bank of Canada and the Fed is to just say, listen, we're on hold for right now. What's nice about that is for companies is it becomes sort of, instead of having to guess, oh geez, we're 2021, 22, and rates are in the midst of starting to go up from below 1 to 5% or something.
You got
stability, which is really good. You can actually make some decisions now and say, okay, well, we can pencil this interest rate into the cost of debt or whatever we're thinking of, and go out and make decisions. We're going to invest in this. We're going to add this much CapEx. We can borrow this amount of money at a reasonable rate, and it's not going to come back to haunt us in 5 years when that loan rolls over, the 5 or 10 year bond comes due. We can make stability is good. And if you've got stability, you can make decisions, and making decisions is generally good for business going forward.
And the ability to just have, it's that sort of, an amount of certainty, ultimately. Canadians love dividends. They've always loved dividends. Even, I was going to ask you, how much is that still true? I mean, there are new generations of investors coming through with different styles that have been really interesting. Are you reintroducing dividends a lot right now because people have been in zero interest rate, situations for, not now, but over the course of the last 15 years? Is there a moment to reintroduce what you do you find?
I think it's become, when the market, I find people start sort of maybe listening a little bit more when the market has sort of fluctuates a fair bit. We have a period where maybe things haven't gone up as much. Last, when some, new startups that have, suddenly worth $10 billion aren't worth very much anymore. Valuations come down because there's a little more uncertainty. Going back to just basics, like, companies, I've got a good dividend. I've got good earnings growth. I've got I'm buying companies at a reasonable multiple where I'm pretty sure I'm not going to lose a lot of money over time. And the idea of, what I say is, like, I try to buy good companies at reasonable prices that maintain and grow dividends over time, and try to do it with a little less volatility than the overall market. And kind of the idea is to keep people invested, keep financial advisors from taking too many calls from their clients over a period. And over 5-10 years, you go back and you look, and you've made a lot of money, and you've done it while actually being able to sleep at night. Right. And for a lot of people, that really, really sort of resonates. And there's the people who, like to just take shots at things and see if they can get, the multi-baggers, and like the sort of the excitement. For a good portion of the population, they don't need the excitement. They just want to be able to sort of say, I'm putting my money in something, I think it's managed responsibly, and I'm going to look back at it in 5 or 10 years, and I've done really well, and I've been able to sleep at night. Yeah,
fascinating. I really think that's fascinating. Take a look at some of the other. Let's go through the sectors a little bit.
Sure.
So, I mean, banks are not hard assets, but they are dividend payers. I mean, almost bond-like they used to be described as. There's some discussion about where disruption belongs in that story. Are they of interest to you? Do you stay away from that sector? What do you think?
No, banks have been really good for the last number of years. The companies took a lot of provisions very early, and then we ended up when housing has cooled off a lot, but we haven't had there's no cliff. There hasn't been that cliff. There was never the 24, 25, 26. The idea was there's so much rolling over. Geez, there's going to be provisions everywhere, or actual losses everywhere, and the losses have never really come in. The companies have generally been doing a pretty good job growing businesses. Capital markets have been good. Wealth management's been good. The company's been growing really nicely. Now it's a case, the multiples are a little higher, dividends are a little bit lower, but there's still, you go and listen to it, it still sounds pretty good. And then there's the idea of, well, maybe there's an opportunity that they could actually do some really good cost cutting. Now, and it's not just by releasing heads, but there's so much of these banks that are legacy systems that have never been integrated, you've done acquisitions over time. It's possible that they spend billions and billions of dollars on software every year. Mm-hmm. Maybe that you never had the sort of the human capital to go and replace, because it just takes too much time, too much effort, too much money. Maybe you can come and use some AI now and rewrite some code and take all hundreds of systems that have all been patched together and make things more efficient. Because people I know that work at banks are always just like, we've got a whole bunch of systems that maybe don't talk to each other that well or been used over time, a bit antiquated. Maybe now's the ability to actually take that and take a whole bunch of costs out by using some new technology and make things more efficient, and with that more profitable. And that's good for stocks.
That's good for stocks. Absolutely. Okay, a couple of different questions here. This isn't quite specific to how it fits within accounts. I might leave that one. But could you share your thoughts on the variable versus fixed dividend payouts in a period of fluctuating earnings?
Yep.
taking a look particularly at commodities companies.
Yep.
That's sort of one of the
Okay.
the questions.
In general, what I'd say for most companies, I prefer sort of the idea you have a fixed dividend that grows.
Okay.
So it grows with earnings. I actually have no problem with the variable dividend things for commodity companies. And what I like to see there is you've got basically a base, and what they will do is say, here's a base dividend. And this is what we can cover
all the time.
Yeah, all the time.
All the time.
We are sure, generally pretty sure, unless Armageddon happens, that at pretty much trough pricing in the commodity, we can still pay this dividend. That way they never have to cut the dividend. And then anything over that, we will pay out a proportion of our earnings in a variable dividend. And I think it's actually a really good strategy for companies where the companies over time will grow production, will grow earnings, but the earnings kind of look like this.
Because that's the cycle.
They're cyclical companies, and cyclical companies probably shouldn't have like a long-term, steady dividend is not always the best thing for especially really cyclical companies. Now, what you may be able to do if the company is improving is take that base dividend and say, okay, well, a couple of years ago we could pay $1 a share in dividends. Our company's gotten bigger, our company's gotten stronger, and at that same low commodity price, we can now pay $1.50 a share. And that's great, and you can raise it that way. But the idea of having a fixed plus some variable that goes in, that is subject to higher commodity prices is great, and hopefully the company's improving itself, improving its cost structure, where that base dividend can grow as well.
Okay, love that. That's fantastic. Okay, here's another one. Traditional Canadian dividend payers are currently looking expensive. So, get your comments on that.
Yep.
For some of the reasons you spoke about, where are you finding value currently?
Okay, so this is the portion of where I like to sort of toggle the fund a little bit. So if defense, like if banks have run a little bit, you've got some pipelines that may have run a little bit. Let's go and find things that maybe have gone a little bit risk off if people don't like things. So I give an example, like rails haven't worked in like 5 years.
Right.
We've essentially been in a transport recession for
COVID really messed with that,
the last 5
Yeah.
years. So we got, and if you look at the stock prices haven't done a lot. So start looking at companies where not a lot has happened. The stocks haven't gone that far, but they're really good businesses, and a lot of other things have gone up. So like transports has been one where the cycle's starting to improve a little bit. We've had a couple truckers reporting. Down in the US, they basically put in a lot of regulations about you have to be English speaking, you have to be American, that's a lot of the workforce has been pushed out, and like trucking rates are starting to go up. Rails are sort of a more efficient version of trucking, so some of the stuff that comes off trucks will go onto rails, and you also have some reshoring and things like that. There are some good things that are actually starting to happen there.
So let me ask you, we don't have a ton of time to talk about this, but as a theme, you've found it really interesting to take a look at an aging population and their needs ultimately. We only have 2 minutes on this.
Yeah,
but
sure.
Tell us about it.
I will go real quick on this. You are finally getting to a point where the baby boom generation is sort of hitting its late 70s and 80s. I love sort of infrastructure type things for old people. And if you look at stocks, especially down in the US, anything related to, and I own a bunch of them, sort of real estate companies that have to do with seniors housing, with skilled nursing, with at-home care, anything where people are hitting 80. We had COVID, so no one wanted to put their parents in any of these things, so no supply got built. And it takes a while to build supply. And now there's this just massive demand for all these facilities because everyone's hitting the age where they actually need the seniors care. And we've got lack of supply and a huge amount of demand, and the pricing power is great. It's just a secular trend that will last for the next decade, and it's just kind of starting. And we've got some of those companies in Canada as well. So it just feels like it's infrastructure. AI can do nothing. You need people. You need actually people and physical assets to take care of people, and it fits really well into the world we have right now.
It looks like you have, or sounds like you have so many opportunities right now, along with the steady ship that you've always
You
been
want
at
to
the
be
helm
able to
of.
steady plus toggling into companies that come on sale that are really good businesses, and there have been a bunch of those over the last month or two. To have a balanced portfolio where you're not all defense, you're not all offense, you just own a bunch of really great companies that we like, that over time should appreciate and pay good dividends.
Don Newman, fantastic to speak with you. Thank you for catching us all up to what you are doing every day. All the best.
Thanks, Pamela.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.